Hi folks, welcome to this video on finding the cash balance given certain pieces of information. So now in this particular question what we're going to do is we're going to determine what should the cash balance be in the current asset cash account at the end of, in this case, 2011. So you'll see here we have a wide variety of data, and what you need to do is not only figure out in the current assets section what your cash balance is, but you're also going to have to determine in the question if there's any of these items from number 1 to 10 that you didn't include in the calculation of cash, where would it go? And is it a current or non-current asset or liability? So let's begin. First of all, we see that in our checking account at the Bank of Montreal we have $200,000. That would always be included in the corporate cash account on its balance sheet or statement of financial position because that's part of what would make up your cash balance. So we're going to include it there. The other thing you've got here is in item number 2. Item number 2 says we have an installment account receivable of $12,000 that's due in 2012 and one that's due in 2013. Well, because we're at the end of 2011, it's an account receivable, but it's just going to be paid because it maybe is due in 2012, but we've given our customer in trade, an opportunity to take an extended period of time to pay it on an installment basis. So they're going to be giving us little payments until it's all paid, but it should all be paid in 2012. That still means it's a current asset, but it's not cash, it's a receivable. So it wouldn't go in our calculation here, but it would go, because it's not included in cash, it would go as a current asset and it would be called an installment account receivable. And again, we would differentiate it from the non-current piece, which because it's due in 2012. Now, in that same item, we have an installment receivable that's not due till 2013. So that's going to be non-current in comparison to our 2011 date. So we would put that here as non-current, same account, but we would differentiate it because it's due in 2013. Now let's look at the third item. We have a bank overdraft of $5,000, but notice that it exists at a different bank. It's at the CIBC. So because it is at a different bank, we can't net it out of the cash balance at BMO. It's a different bank. So that would need to be set up, not netted out of this $200,000, but it would have to be set up as a current liability. So that current liability would be set up in our balance sheet. Okay, and it would be called a bank overdraft account. Sometimes students might be tempted to deduct it from the cash balance that we have, but we can't because the cash balance is being held at the Bank of Montreal. We don't have a bank account as far as we know here at the CIBC. We could only net the overdraft account out at the bank that holds a balance if it was the same bank as the overdraft account is held at. But because they're two different banks, we can't net it out. So we have to set this up as an overdraft liability, okay, on our balance sheet or statement of financial position. The other item we have here is a bond sinking fund. So this would be money that maybe we've set aside out of our own cash balance and we've put it in a fund to retire long-term debt. That long-term debt would likely be a bond. That's why it gets its name, a bond sinking fund. So the company's decided to take some of its cash and put a little bit of it in, maybe a bit at a time, maybe larger lump sum payments or amounts that they're putting in, but it's going into this fund and it exists. So when the maturity date for the long-term debt comes along, we have the money to pay back the face value of the bond. Well, it's $150,000 because it's going to retire long-term debt. It must be a non-current asset. We would set that non-current asset up as a bond sinking fund. So here we have it as a non-current asset bond sinking fund. All right. Sometimes students might put it as just a restricted cash balance in the non-current assets section. The only reason that we wouldn't do that is because we specifically said we're not leaving it as cash or just restricting cash. We're actually putting it into an investment, and that investment has a name. It's a bond sinking fund. We also find here we have a money market mutual fund. It exists at BMO, but it has checking privileges. Whenever we have a money market fund that has checking privileges, it's treated as cash. So for that reason, we're going to add this $15,000 balance onto our BMO checking account balance to determine our cash balance on our statement of financial position or balance sheet. So we're going to add that in here. It doesn't go in this section. It goes in your cash balance only because it has checking privileges. If it didn't have a checking privilege, then it would be different. We'd need to know when it matures so we can include it as either a cash equivalent or a short-term investment. But because it's got checking privileges, it's treated the same as cash because we could write checks on it just like we could a cash account. So it's going to be included as part of our cash balance in our statement of financial position, and that would give us an extra $15,000 in there. We also have a term deposit, $20,000 term deposit. Okay, we put the money in from BMO, right? On December 21st, 2011, but it's got a 180-day maturity. So it's going to be due before the end of 2012, so it's a current asset. But because it matures after 3 years, but less than 12 months, right? 180 days is 365 days in a 12-month period. We've got half of that, so within the next 6 months, that thing is going to be set up as a short-term investment. So here we would have number 6 as a current asset, as a short-term investment. Some students might be tempted to set it up as a cash equivalent, but don't forget, cash equivalents usually mature on or within 3 months. We have a period over and above 3 months, but it's still current, so it would be set up as a short-term investment. Now we also have here that the company has a compensating balance of $20,000 that they're going to keep on their checking account. Now don't forget, keeping a compensating balance is something that the bank, wherever they might have a loan outstanding at the bank might say, well, you know, for example, in our case, we have $200,000 at BMO now. BMO might say, well, because you have a loan outstanding with us, we require that you have a compensating balance. So it's like a minimum monthly balance in your account of $20,000 at all times. So that might have been part of the requirement. So likely they may have a loan at BMO as well, a bank loan. So this is something that the bank sets up, but that is already part of our $200,000, so you don't need to adjust for it. So that is already included in the cash balance. So we would say here, okay, because it's already part of this balance, I'm just saying that the compensating balance is already in cash. It's the minimum deposit required by the bank in order for us to maintain our loan with them. So it's already in here. So you don't need to add it, deduct it, do anything. It's already part of the $200,000. It's a bank requirement. All right. So we don't touch that. We also received a check. That check was dated January 20th, 2012. So it's after our December 31st, 2011 date here. All right. And it says here it's $10,000. It's from a customer, and they're giving us an advance on work that's going to be done sometime in the next month, right? So sometime in January it will be done. Right? But it's a post-dated check, so the work is probably going to begin sometime between the 21st and the 31st of January. But the point is, we've got that check now and it's post-dated, but we can't cash it. So it's not going to be included in our cash balance. It's an item that we cannot include in cash. It cannot be included in cash. So what are we going to do with it? Well, what we would do is, because we can't cash it, we can't put it in any account. So we'd keep it in the cash box or the vault until we can cash it. All right, so it would be in here somewhere. We'd have to account for it, but it wouldn't have an account name. But we would say that it can't be cashed yet, so it wouldn't be included in a cash balance or any other balance. So it'd be a little check that stays in the vault or in the cash box, locked up. Okay, and whoever is handling your cash on a day-to-day basis in your company would cash that check when they can, sometime on or after January 20th. We also have an unamortized bond discount of $25,000 on our bond liability, but our bond liability matures on January 1st, 2016. Well, our bond liability is non-current because we're in the year 2011. The bond matures in 2016. So the unamortized bond discount would be a non-current liability. In fact, it would be a contra liability. I didn't require that you identify a contra liability, but I would have thought you'd know it was non-current, so you'd have to say that. And you could set it up as an unamortized bond discount. In some of your previous courses, that's what you might have done. I would have also accepted if you looked at it as a bond as part of a contra account to the bond payable account. I would have accepted that as well. Okay, so you would have known that it was a non-current liability, but it's contra to the bond payable. And then number 10, we had a customer check for $250. That was NSF, insufficient or non-sufficient funds, and it was a check that was written by our customer, okay, and it was returned to NSF by the Bank of Montreal. Okay, so in any case, what is that? Well, we can't cash it. We tried to run it through our account, to put it in our account at BMO, and we couldn't do that, right? Because BMO says we're not putting any money in your account from this customer because we've checked it out. The customer doesn't have enough money in the account to cover the check. So in other words, it stays as a current asset in our accounts receivable, and we have to go after the customer for the money. So it's not cash because the bank wouldn't put it. So BMO, our bank where we have money in our account, BMO says we're not going to put it into your account because the customer check is no good. So when we receive that notification, we know that we have to keep it as an account receivable. So this concludes our review of what goes into the current cash balance, and for items that don't, where they go in our statements. And again, as is the case of the prepayment or the advance payment, we can't cash it yet because it's a post-dated check. So hopefully that's helped you, and I hope you found the video of help and enjoy it. Thanks.